Well, good afternoon. Happy Friday, February the 12th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. So 14 business days. 14 business days is how long we have been on this negative trend for interest rates. We've seen mortgage-backed securities sell off gradually over the past 14 business days, meaning interest rates are creeping slowly higher, and we're moving further and further away from the historic lows that we saw in 2020 and really at the very first of 2021. So let's talk about that a little bit. If you've been watching this weekly summary in the past, you know I like to reference these mortgage-backed security candlestick charts, and let's take a look at this one. Now, green days are good days. That means the value of the security is going up, which means interest rates are getting better. But here we are today. That's Friday, February the 12th, and you can see when we started here on January the 27th, this gradual sell-off has occurred over the past 14 business days with just a slight plateau about halfway through. What's driving this? That's probably the most frustrating thing for someone in my industry right now, is that there really isn't much technical data that's driving this. If you look at consumer sentiment this past week, we came in below expectations. That would normally buoy mortgage-backed securities and send rates lower. It didn't work. If you look at jobless claims came in higher than expectations. That would normally tell you there's an issue with the economy, and we would see mortgage-backed securities, which are bonds, improve while stocks degrade. That really didn't happen either. If you look at inflation expectations, we came in below inflation expectations and well below the Fed's target for inflation, which is 2%. That did nothing either. So what is causing this sell-off? Well, in large part, it's sentiment. There's one more immediate sort of passing transient reason, and then there's a larger reason that we'll get to in a minute. So the transient reason, the passing reason, is it's Friday before a holiday weekend. Traders want to get out early. They're taking defensive positions. So we're just not seeing a strong performance for mortgage-backed securities. The second, probably more prevalent reason is just the expectation of what is to come for the country this year. We're not there yet, but the expectation is we're going to see robust growth. We're going to see GDP numbers climbing. We're going to see inflation numbers climbing, and this is all going to happen maybe Q2, but definitely Q3 and Q4. Matter of fact, Bloomberg just posted this article, says larger stimulus leads to big upgrade in U.S. growth forecasts. There's the word right there. None of this has actually happened yet. This is all just forecasting, right? But this is what the market is looking at. Matter of fact, they're saying they expect GDP to rise 5.6% in the second quarter and 6.2% in the third. But here's the key sentence. Both of these are 1.6 percentage points stronger than January estimates. If you continue to scroll down this article, you can see inflation. They're actually anticipating inflation to jump 2.2% in the second quarter on a year-over-year basis. So that is above the Fed's target. So really, there's nothing tangible that's happening at this moment to drive mortgage rates higher, to drive mortgage-backed securities lower. But the expectation, the forecasting is what's coming into play here. Now, what does this all mean? Well, you can still get a mortgage interest rate in the 2s if you have good credit and sufficient down payment. You certainly are going to be able to avail yourself of some of the lowest interest rates in the history of the mortgage industry, but it just means don't sit around and wait for rates to go lower. They're likely not going to go back down. As we get into the spring and we start to realize some of this forecasting, interest rates are just going to continue with this slight trend up. Now, the one thing that this is going to negatively impact is affordability, and there's not much any of us can do about that. It's going to impact affordability for a certain segment of home purchasers. That being said, if you're looking to refinance, now is not the time to wait. Now is not the time to sit back and try to pick a better moment to lock in than today. There likely will not be one. So go ahead and take advantage of these incredibly low interest rates. Go ahead and get your refinance underway before we start to see the spring pick up and these forecasts become reality. If I can be of any assistance to you, please don't hesitate to reach out, mark.milam@highlandmtg.com. Thanks.